All right, let's do this. Ready for a deep dive. Today we're tackling how to figure out if a stock is actually cheap or expensive using something called multiples.
Multiples, yeah.
You've probably heard the basics, but we're going to dig a bit deeper today
Absolutely.
so we can really level up when it comes to assessing stock values.
Yeah.
And to help us out, we've got this awful YouTube video from the Plain Bagel. It's called Stock Multiples, How to Tell When a Stock is Cheap or Expensive.
Okay.
And they use this analogy about a butcher shop that really clicked for me.
Interesting.
So let's dive right in. The video starts off talking about Plain Bagel Co. to explain the PE ratio.
Yeah, the price to earnings ratio.
Right. Can you break that example down for us?
Sure. So Plain Bagel Co., they've got, let's say, 1 million shares out there,
Okay.
and each one is priced at $30.
All right.
Last year, they made a profit of $2 million.
Okay.
Now, to get their price to earnings ratio, you just divide the stock price by the earnings per share.
Gotcha.
So in this case, it's $30 divided by $2, which gives us a PE ratio of 15.
So a PE of 15, what does that actually tell us?
Well, it means investors are willing to pay $15 for every dollar of Plain Bagel Co.'s profit.
Okay.
But, and this is important, one number by itself doesn't give you the full story.
Right. We need the context.
Exactly. Context is key.
So how do we start adding that context to the PE ratio? What else should we be looking at?
Well, one important distinction is between what we call trailing and forward PE.
Okay.
The example we just went through that used last year's earnings, so that's the trailing PE.
So it's kind of looking backwards.
Exactly. It's looking in the rear view mirror. But the market, the market's always looking ahead.
Which brings us to forward PE.
Right.
How's that different?
Forward PE, that uses projections, forecasts of future earnings.
Right.
So let's say analysts predict Plain Bagel Co. They think they're going to earn $2.5 million next year.
Okay. New bagel line or something.
Yeah, maybe. Something like that.
Mm-hmm.
If the stock price stays at $30, their forward PE would drop to 12.
Makes sense.
Investors are basically betting on future growth.
I see. But doesn't that rely on, those predictions being right? What if things don't go as planned?
Yeah, that's a great point. Forecasts, they're not guarantees.
Right.
That's why we can't just hang our hat on forward PE.
Okay.
We have to think about how accurate those projections might be and consider other things like, what's happening in the industry or potential problems that could pop up.
Right. Like, what if everyone suddenly decides to go on a low-carb diet?
Exactly.
That would definitely affect Plain Bagel's earnings.
For sure.
Okay, so we can't get stuck on just one number, got to dig deeper. Look at the company's whole story,
Absolutely.
the risks and the overall market, right?
Yeah.
It seems like comparing a company's PE to, its own historical ratios would be a good starting point.
Absolutely. Let's say, for example, Plain Bagel Co.
Mhm.
Historically, they usually traded at a PE of 20.
Yep.
And now it's at 15.
So that could mean,
Well, it could indicate that the market isn't as optimistic about their future as they were in the past.
interesting.
It's what's called multiple contraction.
And the opposite of that, multiple expansion, that would mean a higher PE than usual, right?
Exactly.
But does that always mean good things are happening?
Not necessarily. A higher PE could be because of, genuine growth expectations, or it could just be hype, speculation.
I see.
Maybe there are rumors about a big partnership, but nothing's confirmed yet.
Okay, so we got to look beyond the surface.
Yeah.
So comparing a company's PE to its own history, that helps us understand the market's feeling right now.
Right.
But the video, it also talks about comparing PEs within the same industry.
Yeah.
Why is that so important?
Well, because different industries have different average PE ratios.
Okay.
A high-growth tech company, they might have a higher PE than, say, a stable utility company.
Right.
Comparing those two wouldn't really tell you much.
So it's got to compare apples to apples.
Exactly.
Can you give us an example of how that industry comparison works in practice?
Sure. Let's bring in a couple of Plain Bagel Co.'s competitors from the video, Sesame Sands and the Hengel Bagel.
Okay.
If they're trading at, let's say, PEs of 13 and 7,
Yeah.
while Plain Bagel is at 12,
So that suggests.
it could suggest that Plain Bagel might be a bit overvalued compared to those competitors.
Interesting.
Of course, we need to investigate why those differences exist.
It's like even if that fancy coffee shop has a huge line,
Right.
the coffee down the street might be just as good for half the price.
Exactly.
Now, this all makes sense, but what about when a company has a really low PE? Doesn't that mean it's a great deal?
That's where we have to be careful of what we call value
Right, a
traps.
low PE doesn't always mean it's a bargain. What makes a value trap so tricky?
Well, a low PE, sometimes it's actually a warning sign, not a buy signal. Maybe Plain Bagel Co., their sales are dropping because people are, I don't know, wanting healthier options these days.
Right.
Investors might be worried about future struggles, so the price goes down even though the earnings are, still okay for now.
So it's like seeing a nice house for sale, super cheap,
Yeah.
but then you find out later it's got like foundation problems.
Exactly. That's why it's so important to understand the why behind a low PE.
Yeah.
You got to consider the company's financials, their management, competition, and their potential for growth in the future.
Makes sense.
A low PE, it could be a temporary thing, or it could be a sign of bigger problems.
Okay, so we've talked a lot about PE ratios.
Yeah.
The video mentions there are other multiples out there, each giving us a different perspective. What are some other important ones we should know about?
One that's often used, especially when you're comparing companies with different levels of debt, it's called EV to EBITDA.
Okay, that one sounds a bit more complicated.
It stands for enterprise value to earnings before interest, taxes, depreciation, and amortization.
All right. Can you break that down for us?
Think of enterprise value like the theoretical price someone would pay to buy the whole company. It includes the market value of its shares, but also its debt.
Okay.
EBITDA, on the other hand, that focuses on the company's operating profit before you factor in financing costs or, non-cash expenses like depreciation.
So EV to EBITDA, it's basically comparing a company's total value to its core earnings,
Right.
even if they have different amounts of debt, right?
Exactly. It's like comparing two houses. One might have a bigger mortgage, but we want to see which one is actually making more money from rent.
That's a great analogy.
Yeah.
What about other multiples?
Another important one is the price to book value.
Okay.
This one compares the company's market value to its book value, which is basically the net worth of the company as shown on its balance sheet.
So it's like comparing the price of a used car to the value of its parts, right?
Yeah, kind of. You're
Yeah.
looking at the underlying assets of the company.
When is this multiple especially useful?
Price to book, it's particularly relevant for companies with a lot of tangible assets, like manufacturing companies or real estate companies.
Okay.
If the price to book is low, it might mean that the market is undervaluing those assets. But again, just like with any multiple, you got to understand why.
This brings up a good point. You've mentioned that multiples are tools, not like guarantees.
Right.
It seems like it's all about using the right tool for the right job.
Absolutely. Each multiple has its strengths and weaknesses. And whether it's useful or not depends on the specific industry and company you're looking at. There's no one size fits all.
So ultimately, it's about using these multiples along with a good understanding of the company's story, its competitors, and its future potential.
Yeah.
It's kind of like part art, part science.
I agree. Analyzing companies and markets, you need both quantitative skills, the numbers, but also qualitative skills, understanding the story behind those numbers.
The video emphasizes understanding a company's fundamentals before even looking at the multiples. What are some key fundamentals we should focus on?
Well, you got to look at their financial statements, analyze their revenue growth, profit margins, how much debt they have, and their cash flow.
Okay.
You should also look at the management team's track record, how strong their competitive advantages are, and their ability to adapt to changes in the market.
This sounds like a lot of work,
It can be.
especially for someone just starting out. What advice would you give to someone who wants to learn more about analyzing companies, but they don't know where to start?
There's a ton of resources available, educational websites, YouTube channels like the one we're talking about, the Plain Bagel,
Yeah.
books, even podcasts for beginners. Start by learning the basics of financial statements, key ratios, and some investment strategies.
So it's about taking that first step and building from there. What about finding trustworthy sources? There's so much information, so many opinions out there.
Right.
How do you filter through all the noise?
Look for sources that are transparent, objective, and, backed by research. Don't be afraid to get different perspectives, consider different viewpoints. Investing is a journey of constant learning.
Great advice. So we've established that multiples are useful tools when used correctly, along with good fundamental analysis. Now I'm curious, what are some common traps that investors fall into when they rely too much on multiples? Like what are some red flags to watch out for?
Oh, yeah. It's easy to get caught up in those simple numbers.
Yeah, so what are some pitfalls to watch out for?
One common one is just focusing on a single multiple and not looking at the whole picture.
Okay.
Like getting super excited about a low PE ratio without figuring out, why is it low?
Right.
It could be a great deal, or it could be a sign that something's wrong.
Yeah, it's like finding like a designer dress on sale, like 90% off.
Okay, yeah.
You think you've hit the jackpot,
Right.
but then you realize it's got like a giant rip in it.
Exactly. Another trap is, comparing apples and oranges. Different industries have different average multiples.
Right.
A tech company with a ton of potential might have a higher PE than, say,
Yeah.
a company that sells, I don't know, toothpaste or something.
Right. Like basic stuff everyone needs.
Yeah, consumer staples.
Yeah.
So if you just compare them based on PE, you might get the wrong idea.
So we got to keep the industry in mind.
Yeah.
Understand what drives those differences in how they're valued.
Absolutely.
What other traps should we be aware of?
One that I see a lot is people forgetting that multiples change over time.
Okay.
They're not like fixed numbers. They go up and down based on,
Yeah.
how the market's feeling, the economy, and how the company is doing.
Right.
A company with a high PE today, it might have a much lower PE in a year or two if its earnings grow really fast.
So we got to stay flexible.
Yeah.
Recognize that multiples are just like snapshots.
Exactly.
Got to keep reassessing.
As we wrap up our deep dive on stock multiples, I'd love to hear your final thoughts.
What's the most important advice you'd give to someone who's like brand new to investing?
It's really tempting to just jump in and start picking stocks, get caught up in the excitement.
Yeah.
But I think the most important thing is to invest in yourself first.
Okay. How do you mean?
Learn the fundamentals of investing, how to read financial statements,
Right.
develop a system for evaluating companies. The more you know, the better decisions you'll make.
It's about empowering yourself, basically.
Exactly.
You've covered a lot today. The power of multiples, the need for context, the traps to avoid. What's the one big takeaway you want our listeners to walk away with?
Multiples are really useful for figuring out how much a company is worth, but they're just one piece of the puzzle.
Right.
You got to be critical, look at the bigger picture, and always remember the fundamentals, what's really driving the company's value.
That's a great point to end on. Remember, everyone, investing is a journey, not a destination. It's about learning, adapting, and making smart choices. We hope this deep dive has helped you understand multiples a bit better so you can be more confident in your investing decisions.
Absolutely.
Happy investing, everyone.